All right, get ready to take notes because it is time to talk money and hopefully make a little money, right, Brent?
That's what we try to do.
That's the goal of the business, right? We're talking about Wilsey Financial Management, and today we're going to talk about market dips. So should we buy the market dips?
It's something that people become accustomed to, and again, I try to tell people longer term is like 100 years of the market. People say, well, I've done great with S&P 500 for the last 5-7 years. Market drops, it's going to keep going up, it's going to buy more of it. This is a big mistake because their time horizon, 5 to 7 years, sounds like a long time, but it's really not. I want to give people examples and reasons why I do this. If you go back to March 2000 to March 2010, the S&P 500 made no return at all. It was flat the entire year. People get disenchanted and so forth, so that can happen. And I try to explain to people, it's not a stock market, but a market of stocks. And I tell people, be conservative. You don't have to be the high flyers. That does not mean go to CDs. That does not mean go to money markets. It means try to find good quality companies that aren't overpriced, that pay good dividends and so forth. So these are things you have to look at when you're investing.
So what are the current costs of earnings?
Okay, the cost of earnings, there's something called a PE, and that stands for price earnings ratio. I try to break this down and make sense for people. The price earnings, and we look at a forward one, which means they predict out what it's going to be. Right now in the S&P 500, a little bit higher now because it's gone up a little bit since I wrote this, but the forward PE is 20 times earnings. What that means, it takes you 20 years to get back what you pay for that stock. Now if that sounds high, it is. The average is like 14 to 17. Also too, that's based on the 20-year average. It's 20% above the 20-year average. So when it drops, you're not getting anything on sale, you're getting something at a slightly higher price. So be very careful that you're not buying things on sale. Again, the forward PE 20 times now, which is 20% above the 20-year average. That's expensive.
It's so good we have an expert like you to turn to. It's not like seeing a sale at the store, right?
Right.
What are some other signs?
Well, the other sign too is that there's something called price to cash flow, and cash flow takes out your depreciation earnings. So it's just another fundamental number to look at because again, it's just people say, oh, because of AI, this is going to be great. No, look at the numbers. The numbers tell you the long-term story. Well, the forward PE right now is about 27.3. Now, that's 40% above the 20-year average. So that's even more expensive. And that takes out, again, your depreciation, your amortization. So these are things you look at, that the market, the S&P 500, is expensive. It does not mean you don't invest. It means you invest wisely and you find companies in the market that are on sale. And the S&P 500 is very expensive right now.
The S&P 500 is also very tech heavy, right?
It is, correct. And that's why it's so expensive, because technology, it's about 30% with the earnings, the market cap, all these factors. We pointed these out before. Tech makes a big part. And it's very exciting. You know, tech is exciting. You know, we buy food companies, insurance companies, maybe not so exciting, but we like them because they make good money, pay good dividends over the longer term. And that's what we look at. It's not how we did last week, last month, sometimes even last year, but how's your portfolio doing over a 5 to 7 year period?
Well, looking into your crystal ball, which you're so good at doing, do you think this extra tech spending will ever end?
I don't think it ever will, because that's one thing you look at is that, and the tech companies used to be phenomenal because they had so much cash generation. They were making billions of dollars, and that's why they were better than your old line companies like your manufacturers, because they had to spend money on plant and equipment. Well, now that has changed. Your tech companies are spending, I was reading something last night, Meta, which is, you know, Facebook, their capital expenditures, $176 billion, I believe is a month. And the thing is, we don't see that stopping because it's all on AI to try to get things going. Well, it's technology. We know technology does not become normal. It's always growing. So they're spending $176 billion this year. That doesn't mean they don't want to spend it next year or the year after. Because technology advances, they'll have to keep spending that. So I do believe those high valuations they have will come down because the excitement is there because, oh, how great it is. But you buy a company, a stock, based on the earnings, not just the hype of that company.
All right, wonderful advice as always. I know you look forward to seeing Brent here every Wednesday, but you also have a great newsletter. How do people get your newsletter?
Well, thanks for asking that. That is at our website, smartinvesting2000.com. Again, smartinvesting2000.com, and that has about 10 different topics that we talk about. Very easy to read. People love it. They go, wow, this is great. We love reading this newsletter. Okay. And it's free.
Awesome, wonderful. We love free. Okay, Brent, thank you.
You're welcome.
So much. You know, April is Autism Acceptance Month, and we have some resources for local families next.